Investing is not a luxury reserved for the wealthy or financially sophisticated. It is a fundamental tool for anyone who wants to build long-term financial security, beat inflation, and create passive income streams. The first step toward becoming an investor is understanding that money left idle loses value over time due to inflation, which silently erodes purchasing power year after year. Even if you are starting with small amounts, consistent investing can compound into significant wealth over decades, thanks to the mathematical power of compound interest and market growth. You do not need to be an economist or have a six-figure salary to begin. You just need clarity, discipline, and a basic roadmap. The most common mistake beginners make is waiting for the perfect moment or more money before starting. In reality, time in the market almost always beats timing the market. Delaying your start by even a few years can cost you tens or hundreds of thousands of dollars in potential returns over your lifetime. Investing should be seen as a non-negotiable part of adult financial responsibility, just like paying bills or saving for emergencies. It is not about getting rich quick. It is about making your money work for you systematically and sustainably. Before choosing any specific asset or platform, you must define your personal financial goals. Are you saving for retirement, a house, financial independence? Each goal will influence your investment horizon, risk tolerance, and asset allocation. Finally, educate yourself continuously, not through hype or influencers, but through reliable sources, books, official documentation, and verified financial educators who prioritize your understanding over their monetization. Before you allocate a single dollar to stocks, bonds, or real estate, you must ensure your financial foundation is solid. Otherwise, market volatility or unexpected expenses can derail your entire strategy. Start by creating a realistic monthly budget that tracks income versus expenses, categorizing every dollar spent on needs, wants, and savings. Without this visibility, you risk investing money you may need for rent, groceries, or medical bills, which could force you to sell assets at a loss during downturns. Next, build an emergency fund that covers at least 3 to 6 months of essential living expenses, stored in a liquid, low-risk account like a high-yield savings account or money market fund. This safety net prevents you from dipping into investments during crises and gives you psychological peace to stay invested during market corrections. Simultaneously, evaluate and prioritize paying down high-interest debt, especially credit cards or personal loans charging over 10% annually, because the guaranteed return from eliminating that debt often exceeds what you would earn in most investments. Low-interest debt, like student loans or mortgages below 5%, can often be managed alongside investing, especially if your expected portfolio return is higher. Automate your finances wherever possible. Set up automatic transfers to savings and investment accounts right after payday to remove emotion and procrastination from the equation. Avoid lifestyle inflation as your income grows. Resist the urge to immediately upgrade your spending. Instead, channel the surplus into investments or debt reduction. Track your net worth quarterly to measure progress objectively, assets minus liabilities, and adjust your strategy if you are not moving in the right direction. Understand that financial stability is not a destination but a continuous process of maintenance, adjustment, and discipline. Only when this foundation is secure should you proceed to allocate capital into growth-oriented assets. An asset class is a group of investments that share similar characteristics, behave similarly in the market, and are subject to the same laws and regulations. The 5 primary asset classes every beginner must understand are cash and cash equivalents, fixed income, equities, real estate, and alternative investments. Cash and cash equivalents include savings accounts, certificates of deposit, and money market funds. They offer safety and liquidity but minimal returns, often below inflation. Fixed income refers to loans you make to governments or corporations in exchange for regular interest payments and return of principal at maturity. They are generally less volatile than stocks but offer lower long-term growth. Equities represent ownership in companies. When you buy a stock, you own a fractional share of that business and benefit from its profits through price appreciation and dividends. Real estate includes physical property, residential, commercial, land, or financial instruments like REITs that allow you to invest without owning buildings directly. Alternative investments are typically more complex, illiquid, and suitable for advanced investors. Beginners should avoid them until they have mastered the core asset classes. Each asset class carries different levels of risk and return. Cash is safest but lowest return. Equities offer highest long-term return but highest volatility. Bonds offer moderate return with moderate risk. Diversification across asset classes reduces overall portfolio risk because they do not move in perfect sync. When stocks fall, bonds may rise, and vice versa. Your ideal mix depends on your age, goals, risk tolerance, and investment horizon. A 25-year-old saving for retirement might hold 80% stocks and 20% bonds, while a 60-year-old nearing retirement might hold 40% stocks and 60% bonds. Never invest in an asset class you do not fully understand. If you cannot explain how it generates returns and what risks it carries, avoid it until you have done the research. Stocks, or equities, represent partial ownership in a publicly traded company. When you buy a share, you become a shareholder with a claim on the company's assets and earnings. Returns from stocks come from two main sources: capital appreciation, the increase in share price over time, and dividends, periodic cash payments distributed from company profits to shareholders. The price of a stock is determined by supply and demand in the market, influenced by company performance, industry trends, economic conditions, investor sentiment, and macro factors like interest rates or geopolitical events. While short-term price movements can be volatile and unpredictable, long-term stock performance is primarily driven by the underlying company's ability to grow revenue, profits, and competitive advantage over time. You do not need to pick individual stocks to invest in equities. Beginners are often better served by low-cost index funds or ETFs that track broad market indices like the S&P 500, which holds 500 of the largest U.S. companies. These funds offer instant diversification, lower fees, and historically strong returns, averaging around 7 to 10% annually over decades after inflation. If you choose to invest in individual stocks, focus on companies with strong balance sheets, consistent earnings growth, competitive moats, and competent management. Avoid speculative meme stocks or companies with no clear path to profitability. Understand the difference between growth stocks, companies expected to grow earnings rapidly, often reinvesting profits instead of paying dividends, and value stocks, companies trading below their intrinsic value, often paying dividends. International stocks add geographic diversification and exposure to faster-growing economies, but also carry currency and political risks. Always consider valuation. Even great companies can be poor investments if bought at excessively high prices. Reinvest dividends automatically to harness compounding, and avoid emotional trading. Checking stock prices daily leads to stress and poor decisions. Review your portfolio quarterly or annually instead. Bonds are essentially loans you provide to governments, municipalities, or corporations in exchange for regular interest payments, called coupons, and the return of your principal at a predetermined maturity date. They are considered lower risk than stocks because they offer predictable income and, in the case of government bonds, very high certainty of repayment. Returns from bonds come primarily from interest payments, though bond prices can also fluctuate based on changes in interest rates. When rates rise, existing bond prices fall, and vice versa. The three main types of bonds are government bonds, issued by national governments like U.S. Treasuries, municipal bonds, issued by cities or states, often tax-exempt, and corporate bonds, issued by companies with higher yields but higher default risk. Bond ratings from agencies like Moody's or S&P indicate creditworthiness. Investment-grade bonds, BBB- or higher, are safer, while junk bonds, below BBB-, offer higher yields but carry significant default risk. Bond duration measures sensitivity to interest rate changes. Longer duration bonds are more volatile when rates shift, while short-duration bonds are more stable. Beginners should start with diversified bond funds or ETFs rather than individual bonds, as they provide instant diversification across issuers and maturities, reducing the risk of any single default. Bonds serve three key roles in a portfolio: income generation, especially for retirees, capital preservation during stock market crashes, and risk reduction, because they often move inversely to equities. Inflation-protected bonds, like TIPS in the U.S., adjust principal based on inflation, helping preserve purchasing power. Do not chase high yields blindly. Higher yield often means higher risk, including the risk of losing your principal. Rebalance your bond allocation periodically to maintain your target risk level, especially as you approach major financial goals or retirement. Real estate investing involves owning physical property, residential, commercial, or land, to generate rental income, appreciate in value, or both. Unlike stocks or bonds, real estate is a tangible asset that can provide psychological comfort and utility, but it also requires active management, maintenance, and carries liquidity risk. It is hard to sell quickly. Returns come from two sources: rental yield, annual rent divided by property value, and capital appreciation, increase in property value over time. Location is the single most important factor. Properties in growing, high-demand areas with strong job markets and infrastructure tend to outperform. Direct real estate investing requires significant upfront capital, expertise in property management, and tolerance for tenant issues, repairs, vacancies, and regulatory complexity. For beginners or those with limited capital, real estate investment trusts, REITs, offer a simpler, more liquid alternative. REITs are companies that own and operate income-producing real estate and are required to distribute at least 90% of taxable income to shareholders as dividends. REITs trade on stock exchanges like stocks, allowing you to invest with as little as the price of one share, and they offer exposure to sectors like apartments, malls, offices, hospitals, data centers, and cell towers. Publicly traded REITs are subject to market volatility, while private REITs are less liquid but may offer higher yields. Real estate provides diversification because it often behaves differently than stocks and bonds. It can act as an inflation hedge since rents and property values tend to rise with inflation. However, real estate is not risk-free. Economic downturns, rising interest rates, overbuilding, or demographic shifts can reduce occupancy and values. Leverage, using borrowed money to buy property, can amplify returns but also magnify losses. Avoid over-leveraging, especially as a beginner. Always calculate all-in costs, property taxes, insurance, maintenance, vacancies, and management fees. Net rental yield is what matters, not gross rent. Consider your time commitment. If you do not want to be a landlord, stick with REITs or real estate crowdfunding platforms that handle management for you. Portfolio construction is the process of selecting and weighting asset classes to match your goals, risk tolerance, and time horizon. It is not about picking hot stocks, but about building a resilient, balanced system. Diversification is the cornerstone of risk management. Spreading investments across different asset classes, sectors, geographies, and company sizes reduces the impact of any single failure. A well-diversified portfolio might include U.S. stocks, international stocks, emerging markets, government bonds, corporate bonds, real estate via REITs, and possibly commodities like gold as a hedge. Avoid concentration risk. Never put more than 5 to 10% of your portfolio in a single stock or sector, no matter how confident you feel. Use low-cost, broad-market index funds or ETFs as core holdings. They provide instant diversification and minimize fees, which compound against you over time. Rebalancing is critical. At least once a year, sell assets that have grown beyond your target allocation and buy those that have underperformed to maintain your desired risk level. This forces you to buy low and sell high, systematically, counteracting emotional decisions. Understand your risk tolerance. If a 20% market drop would cause you to panic sell, you are overallocated to stocks. Adjust your mix to something you can stick with during downturns. Dollar cost averaging, investing fixed amounts at regular intervals, reduces the risk of investing a lump sum at a market peak and smooths out volatility over time. Avoid market timing. Even professional fund managers fail to consistently predict short-term movements. Focus on long-term trends instead. Keep costs low. Expense ratios, trading fees, and taxes eat into returns. Choose tax-efficient accounts, like IRAs or 401(k)s in the U.S. and low-fee funds. Finally, write an investment policy statement, a simple document outlining your goals, asset allocation, rebalancing rules, and criteria for adding or removing investments. This keeps you disciplined and prevents emotional deviations during market euphoria or panic. Now that you understand the components, it is time to execute. Open an account with a reputable, low-cost brokerage like Vanguard, Fidelity, or Schwab in the U.S., and fund it with your initial investment. Start small if needed. Even $50 or $100 per month is enough to begin building the habit and experiencing compounding. Choose your core holdings based on your target allocation. For example, a simple 3-fund portfolio might include a U.S. total stock market ETF, an international stock ETF, and a U.S. total bond market ETF. Set up automatic contributions and automatic reinvestment of dividends to remove emotion and ensure consistency. Avoid checking your portfolio daily. Quarterly reviews are sufficient for most investors. Obsessing over short-term fluctuations leads to stress and poor decisions. Track your progress against your goals, not against the S&P 500 or your neighbor's portfolio, but against your own financial targets and time horizon. Adjust your allocation gradually as you age or as your goals change. For example, shifting from 80% stocks at age 30 to 60% stocks at age 50. Stay informed but avoid noise. Unsubscribe from financial media that thrives on fear and hype. Focus on long-term data, not daily headlines. Continue educating yourself, read annual reports, listen to earnings calls, take free courses from universities or financial institutions, and revisit foundational books like The Little Book of Common Sense Investing or A Random Walk Down Wall Street. Tax efficiency matters. Use tax-advantaged accounts first, like retirement accounts. Hold tax-inefficient assets like bonds or REITs in those accounts, and be strategic about selling to minimize capital gains taxes. Finally, stay the course. Markets will crash, pundits will predict doom, and new, cannot-miss opportunities will emerge. But history shows that disciplined, diversified, long-term investors consistently outperform those who chase trends or panic sell. If this guide helped you understand investing in a clear, realistic way, hit like, subscribe for more practical financial content, and comment below with your biggest investing question. I will answer the top ones in the next video. See you in the next one, and remember, start early, stay consistent, and let compounding do the heavy lifting.